Welcome to Do Different, Better Show, where we talk about wealth wisdom and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connect Up Institute, and general partner of the Integrated Capital Fund. Thank you for joining me today. In our last episode, we chatted with Chelsea McDaniel, Director of Impact Investing, and Cristina Lara Agudelo, Manager of Lending Partnerships of Common Future. And we talked about their money journey, alternative lending, and the work of the national organization Common Future, which is bringing innovation and economic justice to finance. In this episode, I'll talk about the types of capital, the process for getting capital, and what you need to know about getting ready for capital. While this episode will be geared towards businesses, if you're thinking about investing in a local business, you will also get some valuable tips as well as what you can do to prepare to make a more confident investment decision. Today, we'll cover 3 kinds of capital, the process for getting capital, also known as due diligence, and how to prepare for capital. So let's get into it. Right up front, there are 3 kinds of capital, and every derivative, every thing that you can possibly think of typically will fall under one of these 3 things. The first one is cash. Second, debt. And the third, equity. And we're going to get into what all of that actually means right now. So that's it. There are just 3. That's it. While there are multiple financing options available, I have not come across a financial instrument that is not one or a combination of these. Now, what can get confusing is there are lots of different kinds of instruments or ways that people can use all 3 of these different types of capital. And we'll talk more about that later in the show. But for now, let's keep it simple and break down each one of these. First, let's talk about cash. Typically, cash, when it comes into a business, does not need to be repaid and has little ongoing obligation. So the different ways that you generate cash or have cash in your business is through sales, obviously. But you can also get donations or gifts. You can have grants. You can have friends and family who give you money. And there's also now, or more recently, crowd raising, peer raising. That's where you see platforms like I Fund Women or GoFundMe and things like that. But those are all in the category of cash. And I'm going to break down each one of those even a little further. So with generating sales is the best way to get capital to your business. The time you spend generating sales, especially volume sales, is where you're going to get the most bang for your buck. It is imperative to have projections that give you some good guesses on the pace and the scale of the sales that gives you an indication of the scope and scale of your profits so that you can prioritize where you deploy your own capital to grow your business, whether that's you need to get new equipment so you can make more faster, maybe you need more employees, maybe you need a building, et cetera, et cetera. Now we'll move on to donations. Donations usually come from individuals who want to support you. They want to support your business, and it's really important because they like you. From there, we're going to move on to what could be close to donations, and that's grants. But grants are different, and they're different because grants are given by an institution, like a foundation, maybe a neighborhood association, maybe it's the state or the federal government or some kind of municipality. We saw a lot of that during the pandemic where governments, our national government, maybe your local government or state government handed out grants for small businesses that suffered during the closures of the pandemic. These tend to be highly, highly, highly competitive and often have restrictions for qualifying. They might be geographically restricted. They may be industry specific. You may have seen that there were a lot of grants for restaurants during the pandemic for obvious reasons. So I always ask businesses to proceed with caution, as these can take a lot of time and energy with very little reward. I think there was one application locally here that generated 10,000 applications for literally what was $50,000. So you really want to think about what are the chances of me getting this grant, and would my time better be used generating sales? I'm always a big fan of generating sales. Then the next category of cash is friends and family, or as my friend Jessica Norwood says, believe in you money. These are typically friends, maybe family, who give you money with little or no obligations for repayment, or at least very friendly terms for repayment. Maybe they say, listen, when you've got it, give it to me, or you know what, don't worry about it. This is, I believe in you. I just want to give you this money to help you get to the next stage of your business. This capital can often be used for hiring, for making prototypes. It can be used for marketing or whatever it is you might need at the time. Maybe it's just to be able to bridge capital between your next big sale or a next big payment that you have on a contract. But it's an excellent way to get investment without having to put in your own money into the business. But realize not everybody has friends and family who are in a position to give them money, which is why I go back to sales. Plus, friends and family capital often comes with fewer strings than traditional loans or other investments. It's not uncommon for customers to be part of your friends and family capital. They just love your product, they love your restaurant, they love your store. And it's not uncommon where if you were to say, hey, we're raising some capital on a platform or something of that nature, or you might just say, hey, God, I'm really struggling right now. And they say, like, well, how much do you need? That is not an uncommon thing. Now, I wouldn't expect everybody to do that for you, but I think you'll get a good sense of who are the champions, who are the ambassadors that are there with you all the time, who are supporting you, want you to be successful. So now we're going to move on to the second type of capital, which is debt. In debt, there are several types of debt. There are credit cards, there are lines of credit, and there are simple or fixed payment loans. And we're going to talk a little bit more about each of those right now. From an investment perspective, you also might hear words like convertible notes, convertible debt, bonds, or certificates of deposits. Those are all forms of debt. So first we'll talk about credit cards. So credit cards are useful for short-term bridge capital, but they can be very tricky to manage for long-term sustainability. They often have high interest rates and compounding interest that can bury a business. I got into trouble when I was in college with credit cards. You walk up to college and you're a freshman and there's a long line of credit card companies. This is back in the day. They didn't have digital marketing at the time. And you went down and each one was offering you, here's a free credit card, no payment for 60, 90 days. And of course, I got me a couple of credit cards and thought that I could just keep spending. And I really didn't put the two together. It's like, no, I've got to pay this back. And I should only spend what I can afford to pay back. I think that story is not uncommon. Now let's move on to lines of credit. A line of credit is exactly what it sounds like. It's capital that sits at the bank until you actually need it. You can draw on it as you need it, then pay back the amount that you've used. You can continue to borrow up to your predetermined credit limit. So when you get a line of credit, it's usually already negotiated the rate, how you're going to pay it back, what the interest is that you're going to pay back. All of that is upfront and the money just sits at the bank waiting for you to use. It's an ideal option for someone who needs access to money quickly or they expect their cash flow to fluctuate in the short term. This is typical with a business that is seasonal. This is typical with a business that maybe has government as their client. Government is often slow to pay. And so they might be 90 or even 120 days before they pay you, but you still have to pay the people who did the work. The interest rate or the amount that you pay on the borrowed money can vary. It can be below market rate, and market rate is usually anywhere from 8 to 13, 15, 18%, all the way down to more convenience store rates, which could be 25, 35%. So the way to think about this is very similar to buying a jug of milk. You can go to the local grocery store and buy a jug of milk and it's going to be X price. Let's just say for conversation, it's $4. However, maybe you're on your way home, you're super exhausted. You really don't want to go to the grocery store and deal with all the people and the parking and the shopping carts of the grocery store. So you end up going to a convenience store. Maybe it's a gas station convenience store, but you're going to pay a little bit more for that milk. That same jug of milk, same exact jug of milk, now might cost $6, right? Because you're paying for the convenience of it being there for you and you being able to zip in, zip out, get it, and be on your way, as opposed to what you would have to do when you go to the grocery store. So this type of loan can be compared to this type of loan can be compared with other secured um, um, kinds of debt, or where you have to leave some kind of collateral or personal guarantee that the money will be repaid. Or it can also work like unsecured debt, like a credit card. But more often than not, you are going to be asked to present a personal guarantee that demonstrates that if you are not able to pay this money back, that you are personally guaranteeing outside of the business that you will pay that back. So here are some characteristics of lines of credit. Lines of credit are usually short term. They could be 3 months to 3 years, but they're not meant to be long term capital like a mortgage for a home, which would be 15 or 30 years. They often require a credit check and due diligence. And we'll talk more about what due diligence is in the next segment. And finally, it really helps with, like I mentioned before, purchase orders, reimbursements. If you're selling your product to Target and you have to wait 60 to 90 days to get paid by Target, you might want to have a line of credit at your convenience so that you can continue to pay workers, buy more raw materials, or whatever that it takes to keep your production line open. Next, we're going to talk about loans. Loans come in a variety of flavors as well. So there are some alternative lenders. We have organizations that are called community development financial. They were literally set up to be these financial institutions that had better rates than the big banks. These are meant to be local. They're meant to, they're able to give these rates because what used to happen is that character was one of the highest factors that they used in determining who they gave capital to, because they are in the community. So the whole idea is that they know the community, they know the people in the community, they know the businesses in the community. So their level of trust is higher, which means that level of trust is reflected in somewhat lower interest rates that need to be paid. Credit unions are also folks that could be alternative lenders. There are loan funds that are by fund managers that also provide alternative lending practices or alternative practices in checking your credit worthiness. Then there are vendor lenders. These are folks like Square, they might be Venmo, but these are what has come into very much vogue of what is called financial tech or fintech. These are platforms that allow money to move very, very quickly, but they're often at a decent rate. And so a lot of times what you'll see is these sorts of programs like the Square program, they're going to give you a loan. That loan is based on the history of your sales on the platform, right? So ideally, they largely work with people who are already on their platform. They look at your sales over the last 3, 6, 9 months, and then they make a predetermined amount of what they will lend you. How you repay that money back is through your ongoing sales. And that rate could be 9, 10, 11% that they're taking every single day off the top of your sales. So let's say, for conversation's sake, you have a loan with let's say Square or one of these other online vendors. You make $1,000 a day in sales. Your rate with them for the loan that they gave you was 10%. Let's just make the math easy. That means they're going to take $100 off the top every single day until the money that you borrowed is paid back. Now, for some people that works. Some people that doesn't work. So definitely make sure you read the fine print and understand when you're using a vendor lender, these short-term loans, make sure you know what you're signing up for. Make sure you understand if there's any fees that are associated with that on top of whatever the loan repayment amount might be. Then obviously banks give out loans, but there are also foundations who give out loans. That is not the first thing that I would go to. They have what are called program related investments. And sometimes their investments, they will take their balance sheet and they will make investments. And those investments could be to loans. That is a very unique thing. You have to have relationships with those kinds of folks. And if you don't, that is not a high priority on the list of opportunities that I would go after, especially if you're a small business. But I wanted you all to at least know about it and know that it's there. Next, we'll get into another type of loan product, which is convertible notes. Convertible notes are an investment tool that's used also as bridge capital between a seed round and a Series A round. And those are terms you usually talk about when you're talking about startups, particularly tech startups or an alcohol brand or things like that. They are a type of debt that can be converted into equity at a later date, allowing investors to receive a return while also having the potential for ownership in the company. So let me break that down. I'm going to give you this money. Let's call it $100,000. You have 2-3 years to pay me back. If you are not able to pay me back, I get an opportunity I can keep the loan alone and allow you to continue, come up with new payment arrangements. Or I can say, okay, at this particular moment in time, if you have not paid me back, this will automatically convert to a portion of ownership, which has been predetermined and pre-agreed upon between the investor and the investee. Convertible notes provide a significant advantage over other forms of financing because they allow companies to maintain control without giving up large amounts of equity or ownership. The third kind of capital is equity. Now, we hear a lot about equity, and equity is not necessarily a bad thing. You hear a lot about equity on shows like Shark Tank, but there are many flavors of equity, and a business should not be afraid to have this as an option in their growing business. But first, let's talk about what is equity. Equity is ownership stake held by investors or shareholders in a company, and it usually provides a return for shareholders over time. It also gives investors confidence in long-term success of the company. Equity is a great way to attract outside investment, particularly if you have some high capital expenditures. Like I mentioned before, if you're buying a building, if you need to buy a piece of equipment. I sit on the board of a social enterprise, and a year ago we had to buy $1 million piece of equipment. So when it comes to something like that, having investors to come in the company allows you to not use your sales cash to be able to make such a big, expensive purchase. But it's a great way to attract outside investment and provide financial security for all the stakeholders and the founders. Equity can also act as collateral for lenders, so providing access to capital for businesses in the need of funding. So when you're being in that situation, being able to say like, oh, I am going to provide, you can say to a bank, oh, I have an equity position in another company and you want to leverage that equity to get yourself a loan for your company. That is something that you can leverage, that equity piece that you own. If you own equity in another company, you can leverage that up to get more capital for your business or other interests. So let's talk a little bit about the types of the types of equity, and we're going to land the plane on this. So there's 4 big types of equity. Once again, this is not an exhaustive list, but these are sort of the big ones that you hear about all the time. So private equity, venture capital, public equity, and angel investing. So first, let's talk about private equity. Private equity involves making controlling investments in distressed companies, but not always. And the hope is that the private equity company is going to come in, turn them around, and make them more profitable. Venture capital is often considered a subset of private equity and refers to making early investments into promising companies or even ideas with the potential for significant growth. The term private equity denotes that there is a share of ownership in the company that is or is not maybe listed on the stock exchange. But the term public equity refers to companies that are already trading on the stock exchange, right? So that's a really important difference when we talk about private equity being off the market and it's private. It's held by individuals, it's held by other companies, as opposed to a public equity, which is when you see like Apple and you see Walmart and they're on the stock exchange. Those are what are called public equities, right? Meaning, literally, like it sounds, they're available to the public. Private equity is usually reserved for a group of people or a group of investors. They typically know each other, but not always. But everybody can't get into that investment opportunity. Next, I want to talk about angel investing. And so angel investing, an angel investor provides initial seed capital for a startup business, usually in exchange for some ownership equity in the company. It's typically a very small amount. Angel investors usually will come in under $200,000. That's usually, some might go up a little bit further, but 200 is usually where people will max out as far as an angel investment. And more typically, you'll see that it's even a smaller amount. We're talking maybe 25 to 50 to $75,000. But there are things that you want to know about equity investments from a business owner perspective. Equity is usually associated with tech companies. If you're a consumer packaged good company or a service-based business, making the case for equity is a little bit more challenging. The number of investors interested in equity investments for non-tech businesses is significantly smaller than investors who invest in tech businesses. A non-tech business typically needs to have $1 million in sales or strong, realistic projections with a solid plan to get there to even be considered seriously by private equity. So next, usually the goal is to sell the company in 7 to 10 years so an investor can make their return. So if you have no plans of selling your business, then private equity may not be the most optimal way for you to get capital. But one thing that's important to know for all of this is that terms can be negotiated, including the levers to buy back your equity. So once again, I like to tell people sexism is real, racism is real, but everything else is negotiable. You're listening to Do Different Better with your host, Elaine Rasmussen. Coming up next, we'll be talking about the process of getting capital called due diligence. And later, I'll tell you how to best prepare for the process in securing the bag from a bank, investor, or other capital provider. Welcome back to Do Different Better. I'm your host, Elaine Rasmussen. We have been talking about the different kinds of capital, making it and getting an investment for your business. Now I'll share with you the process of getting capital. There is a process for getting any kind of capital investment, and the process is usually called due diligence. This process can range from being very intensive, like getting top secret security clearance, or it can be as straightforward as getting your driver's license. Note that I didn't say easy for either one of those things, but more of that in a minute. For now, what you do need to know is that there are 3 parts to due diligence. The first is screening due diligence, then there's the business due diligence, and then there's legal due diligence. And we'll talk about that. So screening due diligence is the first one, and it is often informal and maybe can catch you off guard. For instance, you bump into an investor while networking at a conference or at a pitch session, and you may not know it when this is happening, but the conversations is flowing really, really quickly and a great conversation, and the investor seems to be really impressed by your idea or your business. Little did you know, they've already been digging into your social media presence, your website. They may have talked to other people who know you, and they're all doing this to evaluate whether or not you're worth backing financially, or if you are in alignment with their investment priorities. I've had several people come up to me at a conference or an event and tell me, I've been watching you or following your work for a while. It always creeps me out a little bit, but I'm always flattered. Bear in mind that you should always be mindful of your image, as people are always keenly observing you, even when you don't know that they are. A wise investor once confided in me that they'd been quietly watching me for 2 years, and they'd been combing through my social media engagements and attending a lot of the events where I'd been speaking, and I had no idea. The next part of due diligence is business due diligence. This is when you move into a more formal process of due diligence. At this time, the business is being reviewed by some organization. Maybe it's a financial institution is reviewing you. Maybe it's an investor, a lawyer, a CPA. This is a little bit more of an involved process, and it can take around 30 to 180 days. The investor or their representatives will require you to submit financial, trademark, and other key documents about your business. It won't feel very good. It will feel like you're under a microscope, and that's kind of because you are. But I'm going to tell you more in the next segment of how to make the whole process feel less gross. The last part is legal due diligence. This is the last and probably most crucial step in the investment process. This step is often intertwined with the first two, and it requires you to consult with your own legal partners and accountants. If you don't have them when you're going through this process, you should absolutely get them. I don't recommend anybody going through a due diligence process on their own without their own representation. But you'll be required to interface with their legal partners on everything about your business entity. So your investor may have their own lawyers or their own accountants, and they're also going to be reviewing all of your documents and getting ready for the investment deal. But they're going to look at things like your operating and partner agreements, your articles of incorporation. They're going to be looking you up to see when have you registered with your state? Are you all up to date on all of your state registrations, your federal registrations, your licenses, all of those things? And they are eager to look into those required documents. Prior to speaking to investors, it's just wise to ensure that all your requirements or legal documents have been taken care of so that you avoid any unfavorable surprises. Nobody likes those kinds of surprises. Also, this is the time when you and your legal team are going to be carefully reviewing any deal that's put on the table by the investor or the source of capital. Make sure that your deal requirements align with your business capability and your goals. Now, remember, you are not going to get every single thing that you want, and that is not the goal. The goal is that you can come to some hopefully mutually beneficial agreement about how much is going to be invested in your company. Is that amount going to be paid back in equity? Is it going to be paid back as a loan? How long do you have? There will be things that are like what are called redemption periods. So going back to the example that I gave before, in the convertible note example, if I give you $100,000 and let's say, just to make the math easy, I'm going to give you 10 years to pay me back. In that 10 years, after the 10 years, there will be a redemption period, or it could be before the 10 years. And the redemption period is, what is the amount of time that I can then call on the money that I've given to you? And if you are not able to pay me the money that I've given to you, that I've loaned to you, that then now you need to, we now need to convert to an equity position. And that equity position of your company has been predetermined as well in the convertible note example. So in that convertible note example, we will have negotiated, I'm going to own X percentage of company, of your company. Maybe let's just call it 5%. I'm going to own 5%. But there will also be requirements on like when and how I can sell that 5%. I can't, depending on what you negotiate, I can't just go and sell that 5% to somebody else. So once again, I think there's a lot of fear and anxiety around debt instrument, and there's definitely a lot of fear and anxiety around equity instruments, but you do have agency, you do have negotiating power at the table. And so one of the things that I like to tell people, particularly small businesses, is don't wait till you need money. Start getting ready for money before you actually need money. And part of that, and we're going to talk about that in the next segment, is how do you get your house in order? Make sure that you've got things in line, but also educate yourself on like what is happening in your industry. Each industry will have some I shouldn't say standards, have some sort of uniformly or common practices around what kind of capital those kinds of businesses take in, right? So depending on your sector, particularly if you're in the consumer packaged goods, the way that you're going to grow your business is through debt, right? So just think about that. You are not going to grow your business necessarily through sales. And the reason for that is if you are making more of your product, everything else is going to cost you more. You're going to need more employees. You're going to need more materials. So your profit margin really is going to come by volume discount pricing when you are buying your materials. It could be that you are outsourcing or taking some of the manufacturing overseas. Those, you're starting to look for margins of where you can find extra money, because once again, if you're successful, and I know you will be, you're going to be increasing your sales, but all of your expenses are going to go up. So you need debt to be able to purchase a building. You need debt to be able to have a line of credit to pay on those folks who are slow payers for your invoices, right? So these are all the things that you really want to think about and embrace and be open and educate yourself, because having debt as a company, particularly a small business, is not a bad thing. The bad part comes in when you do not have a capital plan to know how you're going to pay the money back, right? And so there are folks that can help you with that. And so you need to seek out those folks in your entrepreneur ecosystem to let you know, to help you on that journey and help you figure out some of those things. You're listening to Do Different Better with your host, Elaine Rasmussen. Coming up next, we'll be talking about how best to prepare for investment, whether you're an investor or getting an investment. Welcome back to Do Different Better. I'm your host, Elaine Rasmussen. We've been talking about the due diligence process of capital, making or getting an investment for your business. Now I'll share with you on how to get ready for the capital investment, the questions you need to ask if you're getting capital or looking to invest in a business. It seems simple, but a lot is encompassed in those three due diligence steps. So I've broken it down for you in our Dirty 30 checklist. The last thing that we'll talk about are the components of the Dirty 30 checklist. This list was created from my years as an investor and adapted from a colleague of mine named Sandeep Giri. So first, what is the Dirty 30, Elaine? These are about 30 questions or so that anyone giving you capital or credit may ask you about the business. These questions get you in the mindset of the person investing in your business. If you're new to angel investing, this is a great list of questions that you can uniformly use to make an objective analysis of a prospective investment. Other people who might find the Dirty 30 list useful could be prospective employees, creditors, lenders, investors, strategic partners, etc. Whether you're looking for capital or an investment or not, it's a good idea to think about in advance how you want to address these questions. Now, why do I call it the Dirty 30? I call these questions the Dirty 30 because the work it takes to work confidently to answer these questions is kind of like doing a big pile of smelly, dirty laundry. Though it's super, super important, and business owners often avoid this crucial task. Though critical business owners, if you really want to be successful, whether you're looking for an investment or not, this is just a good baseline for you to be able to have a really good grasp of not only how you see your business, how others see your business, but constantly checking those two things and seeing where there might be tension. When seeking any kind of capital, investors or capital providers will inevitably pose these questions that fall into 6 categories: your product or your service, your company structure and history, your leadership team and expertise, your financials, your sales and your growth plan, your production and operations, and some other intangibles. You can be sure to download the worksheet, the Dirty 30 checklist of questions that you need to answer by coming to my website, www.socialimpactnow.com, or you can hit me up on the DMs and my socials, and I'll be happy to get that list to you. These are not the only questions that you can or should ask if you're an investor. Some of these questions may have to do with specific industry things that have to see how you fit among your industry peers, right? So let's say you're going into the tech industry. There might be some specific questions that are typical of a tech startup that will be asked. Things like, what's your conversion rate? How long and how much does it cost you to convert a customer into a customer? What's your retention rate? How long do you keep your customers? What's your attrition rate? How long is somebody a customer on your platform before they jump off? Those are things that could be specific to a particular industry, particularly the tech world, right? Some other questions, maybe if you're in the consumer packaged goods brands, they might want to know what's the weight, what's the pallet weight of your particular product, things like that. So you'll start to see as you look at different industries will have additional questions on top of these questions that I'm asking you now. Now that we know what the process, it's time to do the work. After answering all the questions in the Dirty 30 checklist, you'll be equipped with the most critical information you need to speak with investors or other potential sources of capital with confidence. The checklist positions you to have practically everything covered and helps you make a solid impression. As I mentioned in the previous segment, there are things that you can do as a business owner to be better prepared and well positioned for a more positive due diligence experience. The biggest thing that I can tell you is have your financial documents prepared and at the ready. These documents should include your profit and loss statement, your balance sheets, your cash flow statements, your knowing what your cost of goods sold or your customer acquisition journey or price, your organizational budget, and those are typically done year over year over year. Your projections, what are you projecting to do? And what's the rationale for those projections? Is there some new technology that's coming into the fold that's going to allow you to be faster or more efficient? Is there something I'll tell you in Minnesota, we've recently passed recreational cannabis. Okay, so that's something where you can say, hey, we were a CBD business. And so we're going to have some exponential growth because now we're positioned to move into the cannabis field because we've already been doing CBD, which was legal prior to recreational use of cannabis. And then other organizational documents such as your trademarks, like I mentioned before, your operating agreements. It's really, really important. Your contracts, if there are any contracts, particularly if you've got contracts with, let's say, a Target, make sure you have that at the ready. Make sure you have particularly your high ticket contracts. Not your onesie twosies. Those are good to have in a filing cabinet as well. But those big contracts that maybe represent 10, 20, 30% of your business, have those contracts because they will be asked for just to demonstrate that you actually have these contracts. Here's a quick tip. Keep all these documents from the checklist in a digital folder that is easy to access. Some might say a jump drive. I'm always wary of a jump drive because jump drives get lost. Jump drives get corrupted. Jump drives, sometimes your partner needs the information. If they don't have access to it because you have the jump drive, that can be problematic. There's lots of platforms where you can store it securely and digitally. One platform is DocSend, another is Doc Hub. These are places where you can put these documents and update them regularly. And you can also give permission to other people to have limited viewing access to those documents. So for example, if you wanted to say, hey, this person can have access to this document for 7 days, you can build that in and give them a link. And that is intuitively built in based on the parameters that you set on the platform, that once that link is 7 days old, they will no longer have access to these documents. It's a really good way for you to secure your information, but be able to give it and have it readily available, not only for yourself, but for other folks that might need it. And quite frankly, you'll be taken more seriously if you can get to these documents quickly during the due diligence with the due diligence partner or banker. Once again, send me a DM on my socials and I'll be happy to send you a full checklist. The next thing you want to do is get your house in order. Get your stuff together, or what I like to call gist. Getting your house, your financial and operational infrastructure in order is key. It is just a good business practice and process. It will be required for any kind of investment, and it will be the foundation of your business and long-time growth. And it requires you to be clear about what you need and what you need it for and how much you will use and when you get the capital, right? So when we talk about that data room that I talked about, having a digital file where all of these forms are or all of these documents, every quarter update you can set up if you're on QuickBooks or another platform, you can set it up so that it will send you a profit and loss statement on any day of the week, any day of the month, any day of the quarter. So if you set that up, now you will have your profit and loss statement drop into your email box. And then all you have to do is drop it into your digital file. And you should be constantly updating those on the regular and reviewing them. You should be reviewing them. And you can upload those to your digital data room. So one of the things that, why it's so important is you want to be able to manage your your business. And what's so valuable about this is even if you're not looking for any kind of capital whatsoever, this is just really good standard practice on understanding and knowing and always having your finger on the pulse of your business and being ready. My grandmother used to say, if you stay ready, you ain't got to get ready, right? Well, this is kind of that when I talked about getting ready for capital before you actually need the capital. These are all the things that, let's say today you don't think that you're going to need capital. I had a friend of mine who said he was thinking about getting a line of credit. He's like, I don't really need a line of credit. He went through the process of getting a line of credit anyway, but he's like, I'm never going to need it. I don't think I'm going to use it. And literally 2 months later, he had a slow payment on one of his invoices, and he had to draw on the line of credit so that he could pay his employees. And he was so grateful that he had done that exercise so that he was able to pay his employees and be able to keep his business running this whole entire time. So, once again, I know that particularly people who come from poorer communities, people, Black and brown people, we don't have the best relationship with lending. I don't know about you, but I was taught never to owe people money, never borrow any money. But quite frankly, that may be applied to your personal life. It does not really apply to your business life. You cannot grow. And I've had many entrepreneurs who I've talked off the ledge. And once they finally got a debt instrument and got some debt capital, they were very grateful because they were able to maneuver their business and grow their business in a way they just would not be able to do with just their sales, right? So these are the things that you want to be thinking about. Debt is not necessarily a bad thing. It's just one of those things that you have to be mindful and manage. And the same thing with equity. When you're doing equity or you're considering an equity investment, there are lots of people who can walk you through what that needs to look like and ask you questions like, what is the maximum number of equity do you want to give away? If the pie is 100%, what's the most amount that you're willing to sell up? That doesn't mean that that's what you should sell up, but what's the maximum amount? You also have to take in consideration if you have partners. If you have 3 partners and you all own a third, every time you bring in an investor, you dilute, and you might have heard that term, dilute all of the owners, because that equity needs to come from somewhere. So let's say you bring in somebody who has 6% equity. That means each one of you have now reduced your 33% ownership down to 30% ownership. And so people hear horror stories about getting kicked out of their companies. Well, I want you to go and actually investigate some of those stories. Some of those people needed to be removed from the company, right? You've heard some of the stories around Steve Jobs and some of the others. But there are things that you can put in place to help protect some of that. But it could be part of your exit strategy as well. If you've been growing a business for 10, 20 years, then you might be okay with lowering your equity stake because you're looking to exit the company anyways. But these are all things that are negotiable, right? These are all things that you're going to constantly have to be faced with as you're growing and thriving in your business. So I hope all of this information was helpful for you to wrap your head around some of the things around capital, the different kinds of capital, but it can be a really fun journey. It's a little bit exhausting. It's a little bit tedious, but I guarantee you it is worth a while because you will be well positioned to be confident in your business, understand the financial management parts of your business, and be able to really take on and take ownership of your business and all of the things that you do. Right. So, well, that wraps up another episode of Do Different Better with Elaine Rasmussen. Today we talked about the different kinds of capital, the process of getting capital, and how investors and businesses can better prepare for the due diligence process. I cannot wait for next week's conversation. Join me in the next episode of Do Different Better with Elaine Rasmussen. I'll be talking about identifying your conscious and unconscious tapes around money and identifying your values and goals. I'll have some practical and tactical tips for you to align your values with your money and your goals. See you next week, and I'll show you how to do different better. But don't forget, let me know what you think of the show. We love comments, so tell us how this show helped you. If there's a money or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. Don't forget to hit the subscribe button and follow us on our socials.